Good morning. Today we are going to talk about 4 ways of how to live off your portfolio. This is the way that the rich people do it. You don't need to work hard, you need to play smart because hard work is rarely bona fide. So let's get straight into it. And if you stick around to the end, I have an extra 5th way of investing and eventually how to live off that portfolio. The first option is to buy companies that provide you with dividends. They give dividends quarterly or yearly, depending on your needs. These companies are, for example, Coca-Cola. As you probably know, Coca-Cola is one of the stocks that is held for the longest period of time by Warren Buffett. Depending on how much you have invested, you can still keep your stock in Coca-Cola and live off the dividends that they pay you. This is a good stock and a good way of keeping your money invested. This is the kind of stock that you buy and hold forever. 2026 is the year when Coca-Cola marked its 64th year of increasing their dividends paid to their shareholders. This is where it gets interesting. Instead of cashing in on the dividends that Coca-Cola, for example, because there is more companies that work this way, you can reinvest dividends they are paying you. Those dividends that are going to be reinvested are going to compound over time and increase your portfolio. Those additional shares will have produced their own shares, so that means even more income for your beloved portfolio. One of the most interesting ideas why people select to invest in companies like this is that you can get the cash without selling your shares. That's quite amazing when you need a bit of extra cash, but still want to keep your shares. That I will tell you later on what you could do with the shares that you have in a company such as Coca-Cola or maybe Procter & Gamble. They have the same ideology. Johnson & Johnson is another one. These kind of companies, they can create their own income stream, so they are not only dividend payers, they are dividend growers. Coca-Cola, for example, has raised its dividends for decades. My favorite part of investing in this way is that along your investor life, how long it may be, hopefully very long, you will have the market crashes. When your portfolio drops like 25%, let's say, then the psychological factor is still very valuable because you will have your dividends coming into your wallet. So you will get cash without selling stock during a crash, which is amazing because during crashes, most businesses not only go bust, but they kind of slow down. So depending which area you operate in, like in my case, aviation, it's the aviation, you can even hear the aircraft up here. Hello. This is the first industry that will go down when a crash occurs. Maybe COVID was not a crash, but was definitely a big change in the market. That would have been a really nice time to have companies that pay the dividends. And of course, if you get paid the dividends, you get the cash, and with that cash, you can even, if you want, invest in other companies or whatever, go to the bar. That is one mode that you can use this kind of investing strategy to make the crashes psychologically at least easier. The companies that pay the dividends are established companies. As I said, Coca-Cola, Johnson & Johnson is an example. McDonald's. When in this lifetime will McDonald's go bust? Come on, let's be serious about this. The second way to live off your portfolio is to buy into the companies that reinvest the dividends. The companies will reinvest the profits for you, and you will get a higher profit margin. But you can only cash in when you sell your shares. That is one example. It's Apple. They don't necessarily give you dividends, they only pay a very small amount. But the fact that they reinvest the dividends for you, imagine that if you buy $10,000 or euros of shares in a few years, those dividends of $10,000 or euros can make up to maybe 40,000 euros. So definitely a higher profit margin than if you would be taking the dividends quarterly, like with Coca-Cola. So you have a potential higher capital appreciation. That is the big attraction. But that will only happen when you will eventually sell your shares. That's fundamentally different than when you would buy into Coca-Cola and you would quarterly get the dividends in your own pocket. When buying into companies that don't pay you dividends, but you gain more of the investment, that means you get to control your own money because they are your shares and you can sell them whenever you desire, whenever you need the cash. So you can decide when to take the possession compared to the companies that pay you dividends. Another example is Amazon, that they aggressively invest your dividends, and that means a much higher income over time. Tesla is yet another example where they reinvest heavily the dividends, and when you buy into Tesla, your bet is that that company will have major growth within 5, 10, maybe 20 years. The third and one of also my favorite ways of living off your portfolio is lending against your portfolio. If your profit margin is higher than your interest rate, then you are making money. This is a real strategy called securities-backed lending or portfolio-backed lending. But there is risk into it because over a long period of time, you are expecting, let's say, a 10% income. But when you lend money against that, you lend money with 5% interest rate. So the 5% interest rate, that is contractual. So your profit of 10% might fluctuate. It might be 10%, it might be 8%, or it might be 4%. So that is the risk involved. And how this works, imagine you need $50,000 or euros, and instead of selling shares that are worth 50,000, a broker or a bank will allow you to borrow 50,000 euros against your portfolio. So you will still have the stock invested and get the 50,000, which you are going to pay the interest on. This is one way that the wealthy investors prefer to operate, mainly because they remain invested. They don't have to sell their shares that they obviously believe in. So if you have $1 million of investments and you continue to sell them, you remove the compounding system from your asset box. While borrowing against the $1 million portfolio will allow you to remain invested. Another important reason why it's better to borrow against your portfolio is that borrow money does not come with taxation. So when you are selling your shares, you have to pay the taxation. When you are borrowing the money, that is not considered taxable money. So that is absolutely interestingly convenient to operate in that way, and that's why most of the wealthy people will select that option. In that order, you are going to control the moment that you sell. You don't have to rush into selling into a market that is down. You can take your time, assess, and sell when you please. Let me take a few seconds of your time and talk about today's sponsor, and that sponsor is you. Yes, you. Because if you like the video and if you share it and if you subscribe, that will help the channel and that will help me to make more of this kind of videos. So now let's get back into it. So the bottom line is that your assets, while they are invested, will have outgrown the interest. You still get to acquire the cash for your own personal use, and your portfolio keeps compounding, and you also make money out of that. The fourth option, and probably my own favorite, is buying into the S&P 500 fund. This is very convenient because, first of all, you can set it automatically. So out of your own income, salary, or whatever source of income you have, you will be able to make it automatically. So put maybe, I don't know, 500 euros, 1,000 euros, or 10,000 euros, say monthly. It depends on how much you're making. So that is an automation. The money continues to pile up, and then they compound one after another, month after month, year after year, and decade after decade. So when you finally have a considerable amount of funds in your own portfolio from investing into the S&P 500, the best option is to live off of that fund. You can sell 4% of your total portfolio. But the thing is, once you reach a certain level and a certain period of time, that 4% that you will sell out of your S&P 500 portfolio will be less than the compounding that you are already acquiring within the time. So even with selling the 4%, you may be, let's say, just for reasoning, you may make up 6%, let's say, from the compounding. So then your earn will be a 2% every month without you doing nothing, and even more spending the 4%. If you want even more, you can take out of the 2% even, so you're left with still 1%, and depending on the size of your portfolio, that will be a considerable amount, because if you keep putting money every month along the years, this is an investment that has to be at least for 10 years. But in my situation, in my view, this is a mandatory situation. Whatever kind of money you make, you have to put in the S&P 500, because the companies that are included in the S&P 500 are the most successful in the world. So today maybe it's Apple, tomorrow maybe it's SpaceX. How do we know? We do not know. Nobody knows. So if you have a preferred stock, for example, now with the SpaceX, say you put a value of 5,000, 10,000 euro in the company, how do you know that they will make money in 20 years from now? Of course, there is a high chance of them doing that, obviously, Elon Musk. But then again, would you take all your chances and all your money to put it in one single company, in one single basket? So if you are willing to take that risk, of course, you might win big. But if the loss is high, I would still have some S&P 500 on the side fund attached to my whole portfolio management. These are the 4 ways you can lend against your portfolio. You can choose according to your own comfort and needs. I want to talk about the 5th one, which I consider as a bonus. A bonus idea, maybe. I know it's been around for long periods of time. I'm talking about the observational investor. The term of observational investor has been available for long periods of time, 10, 20, 30 years. You check the market, you see what it does, and then you select a few companies that you might think that will do well, and you put some money in there, which is the thing that normally is done by Wall Street and institutional investors. So you have institutional investors and you have observational investors. But think about the difference between them. Institutional investors means Wall Street, okay? The data that they are using is big, vast, and they pay millions, if not billions of euros for it. For example, they will look at credit card usage, how people are using the credit card. Are they buying TVs? Are they buying Apple iPhones? Are they buying Samsung? Are they buying Red Bull or Coca-Cola? So they gather all that kind of data and they make assessments and make a decision which of these companies deserves more money and which of these companies deserves less money. So they will take your money and invest it in those companies. But now look at the observational investor, okay? What do people do before they buy the iPhone, before they buy the Samsung phone, before they buy the couch or the new car? They will talk about it, okay? They will talk about it with their friends, with their family. And how will they talk about it? We are in a new era where everything is happening online. You have Instagram, you have TikTok, you have YouTube. How do you spot these people and their needs and their desires? It's just simple and incredible data that you and even and only you can acquire by being present on the media, by simply even reading the comments from TikTok. Because before people buy something, they will talk about it. They will check the reviews on different products. They will watch videos. If you use the search bar on YouTube, you can assess which kind of products are more searched, which kind of products are more reviewed. So this will be the edge that you will have in front of the institutional investor, the Wall Street investor. The Wall Street investor will take the data that comes later in the credit card information, but you can get ahead of that with seeing the people before they buy, before they make the acquisition. So then you can make a quicker decision before even Wall Street, okay? Because in all honesty, there is not a 100% trade for anything. Whoever you are, whatever you are, there is always a 50-50, 60-40, 70-30 possibility of winning or losing. Don't ever think that Wall Street, the institutional investors, they know for 100% what they are doing. They might have an idea. They have the backing of the years, tens of years that they have been operating around the markets. But that is like an army. They are very slow to move. You know, you have to move everything like a huge army. You have tanks, soldiers, planes, aircraft carriers. Instead of consider yourself as a guerrilla fighter, you come up with your army of ChatGPT, of Claude, and Gemini, and you go in and you give a small hit, and then you come out real quick, so you're quick, you're ahead of them. Of course you will not have the money to invest. They have billions of dollars, of euros, to play around with. But if you are quicker than everybody else, that means so much more than having tons and tons of money that you need to move around. So the observational investor is one thing to really keep in mind, and I would advise you to look more into it, because the world now is more connected than ever and ever before. Even the kids, if you look at the kids, they are all online. They do not go out, they do not play as much, and then the teenagers, they don't go so much as before at the parties. Everything is online, everybody is talking online, everybody is in the comments, they are on the forums, they are on the blogs. So that is valuable information that, guess what, Wall Street is not able to use to their advantage, because they do not have the courage and the muscle to do it. They are slow, but you can be quick to assess. Imagine COVID, for example. COVID was a major change in the way that we live, the way that we shop, and the way that we do the activities. Any major change that affects everybody is a way to get the edge on the market and to notice what kind of companies will be harmed and what kind of companies will win. COVID passed, of course, it's not the case anymore, but now we have AI, which is a major world change. We are in the new era. Even if you don't realize it, the world is changing as we speak, as I'm shooting this video now. This is a major change. My skin is getting goosebumps, because this is crazy. It's never happened, maybe never before in the human history. So if you can take the AI boom, is it a bubble? We don't know, but there will be major changes with the companies in the next 5 to 10 years. So if you can spot the winner, you will be the winner. If you can spot the loser, again, you will be the winner. So this is a great change, and great changes, they level up the playing field. It's just that you have to be on the lookout. You have to look around you, what's happening left, right, online, in the comments. Everything is just out there for the taking, okay? You just need to think about it, to spend your time as you are spending it normal, but you have to take into account and do more of your observation in regard to the market. We're at episode 31. This is going to go live in I think tomorrow even, because I'm a bit late with my shooting, and I don't have a way to write in the sand, because I'm into a forest that is next to the sand, that it's very sunny out there. But I can report to you that at this moment we have 39 beautiful subscribers. So please continue watching and enjoying my crazy investing ideas and my ideas of living a good and especially free life. This is what we need, all of us. Freedom is the most important thing that we can ever acquire, more than money, more than wealth, and more than anything else. Freedom and happiness. I will see you again in the next one. Remember this, life is easy, it's the people that complicate it. Ciao, I will see you. Ciao.